Most countries today celebrate rising GDP, booming markets, and record-breaking growth. But what if all that progress is nothing more than a beautifully crafted financial illusion? An illusion so convincing that even world leaders don't fully understand it. An illusion that makes nations believe they're becoming wealthier, while their real purchasing power quietly shrinks, their debt levels explode, and their economies grow more fragile with every good year. This is the part of global finance no one talks about, how governments manufacture the appearance of wealth without creating any real value underneath. And once you see how the illusion works, you won't be able to unsee it. What if I told you that for more than a century, almost every country on Earth has been celebrating a rise in wealth, while quietly sinking deeper into the very system that guarantees they will never actually become richer? A system that looks like prosperity from the outside, but operates like a financial sleight of hand trick from the inside. A trick so effective that entire nations parade record GDP numbers, rising stock markets, booming credit flows, believing they're leveling up, while the actual value of their money dissolves beneath them. Today, we're pulling apart that illusion. Not just inflation, not just money printing, something deeper. An operating system of modern finance built to look like growth even when it's hollow. This is the financial illusion that makes countries think they're getting richer. Setting the stage. To understand how this illusion works, we need to go back to a world where money was simple, boring, and brutally honest. A world where a dollar was a claim on something real, not an entry in a digital ledger. The 1800s into the early 1900s were defined by the gold standard, a monetary system so restrictive that governments couldn't spend more than they physically had. Nations couldn't magically grow their money supply. Debt couldn't explode. Growth was slow, heavy, and sometimes painful, but it was real. Then, across wars, political pressure, and global power shifts, something changed. A new financial philosophy emerged, led by governments desperate for flexibility, bankers hungry for power, and economists who believed they could engineer prosperity. They didn't just tweak the system, they rewired the entire foundation of global money. And this is where the illusion begins. Origins of the illusion. It started with a simple idea. If money is too restrictive, loosen it. World War I pushed nations to print more currency than their gold reserves allowed. World War II shattered what remained. Governments realized something profound. If you detach money from real value, you can grow the economy on demand. The watershed moment came in 1944 with the Bretton Woods Agreement, when global powers, led by the rising United States, created a new structure for world finance. Most currencies were pegged to the USD, and the USD, pinned to gold, at least on paper. But countries were already stretching the rules. More spending, more borrowing, more ambition than the gold supply could support. The final break came in 1971, when President Richard Nixon ended the dollar's gold convertibility, what historians now call the Nixon shock. From that moment on, the world entered a new era. Money was no longer backed by anything except trust. Governments could grow economies simply by expanding the money supply, and banks could multiply that money through fractional lending, creating layers of credit far above actual savings. This was the birth of the illusion. The rise of the illusion. Once money became unanchored, countries discovered a powerful trick. You can boost GDP instantly by expanding credit. Want higher growth numbers? Encourage borrowing. Want a booming housing market? Lower interest rates. Want consumers to feel richer? Make debt cheaper. It looks like prosperity. People buy homes, cars, gadgets. Corporations expand. Governments announce historic growth. But the growth isn't real productivity. It's leveraged consumption. This is why, from the 1970s onward, we saw exploding national debts, soaring corporate borrowings, expanding household credit, asset bubbles in housing, stocks, and commodities. Meanwhile, real wages stagnated, savings rates collapsed, and productivity rose much lower than money creation. Countries saw bigger numbers, but those numbers were inflated by the expansion of currency itself. Money was multiplying while value wasn't. The breaking point. The illusion became dangerous when nations realized the system demands constant expansion. If growth slows, the illusion falters. If borrowing decreases, GDP drops. If credit tightens, asset prices fall. The system is addicted to its own trick, and addiction always has a breaking point. The first major warning shot came in 2008, the global financial crisis. The world discovered that the prosperity of the 2000s was built on mortgage debt, shadow banking, and financial engineering. Governments stepped in with the only tool the illusion offers: print more money, borrow more money, lower rates, inflate again. Then came 2020. A shutdown of the global economy, an event that normally would have caused a depression, was solved by injecting over $10 trillion of new liquidity worldwide. Markets soared, housing prices surged, savings inflated artificially. But what followed? The highest inflation in 40 years, and purchasing power collapsing in nearly every major currency. The illusion isn't failing because it's broken. It's failing because countries need bigger illusions every time. Fallout of the illusion. When money creation becomes the primary engine of growth, three things happen. 1. Prices rise faster than incomes. Currencies lose value. People feel poorer even during economic booms. 2. Debt grows faster than GDP. The world crossed $315 trillion in global debt, over 3x global GDP. This is unsustainable, but the system requires it. 3. Wealth concentrates at the top. Those who own assets, stocks, real estate benefit from artificial inflation. Those who depend on wages see their purchasing power evaporate. Countries report higher GDP, but citizens experience shrinking real wealth. That's the illusion. Money numbers rise, capabilities fall. Nations celebrate, people struggle. Failed fixes. Every time the illusion starts to crack, policymakers offer the same solutions: lower interest rates, increase public spending, expand credit access, print money through quantitative easing, reinflate asset markets. But these are not solutions. They're extensions of the illusion itself. Lower rates increase borrowing. Borrowing boosts short-term activity. More activity boosts GDP. Higher GDP makes leaders claim success. But the long-term damage compounds. Once a country enters this cycle, backing out is nearly impossible without recession or worse. Japan tried decades of stimulus. Europe tried negative interest rates. America tried trillions in QE. Emerging markets tried cheap credit booms. Every attempt led to the same outcome: short-term growth, long-term fragility, modern parallels, and shocking patterns. Look around the world today. The US prints more money in 2 years than in the previous 40. Europe faces inflation levels not seen since the formation of the EU. China builds entire ghost cities to artificially inflate GDP. Japan holds more government debt than its entire economy produces. Emerging nations drown in dollar-denominated loans they can never repay. And yet, every country continues announcing economic growth. Because the illusion isn't a glitch, it's a feature, a built-in mechanism that lets countries inflate their numbers, mask weaknesses, and claim progress, while quietly diluting the real wealth of their citizens. The same pattern repeats across history: expand money supply, inflate assets, celebrate growth, ignore debt, face crisis, print more money, inflate again. It's the loop countries can't escape without rewriting the entire monetary system. 3 key takeaways. Takeaway number 1. Growth without productivity isn't wealth. If a country's GDP rises faster than its real output, it's not getting richer, its currency is weakening. Takeaway number 2. Money printing hides problems, it doesn't solve them. Nations use inflation to mask debt crises, underperformance, and political failures. Takeaway number 3. If everything appears to be booming, check the foundation. Most modern booms are built on credit, not capability. On liquidity, not value. This illusion won't last forever. Every financial empire built on debased currency, from Rome to France to the British pound, eventually hit a breaking point. And today, nearly every major nation is running the same playbook at the same time. When the illusion finally unravels, it won't be one country that suffers. It will be the entire global system. The question isn't if the illusion cracks, but how the world responds when it finally does. If you want more deep dives into global money, hidden financial history, and the economic systems shaping your future, Make sure you subscribe, hit the like button, and share this video with someone who needs to understand what's really happening behind the numbers. Because the illusion only works if people aren't looking too closely. And now, you're looking.